In July of 2026, the Industrial and Commercial Bank of China, one of the largest financial institutions on Earth, will permanently shut down paper gold trading for its everyday customers. The bank claims this protects ordinary people from gold's volatility, yet ICBC is not moving alone. The Postal Savings Bank of China and Ping An Bank have followed suit, ending the exact same product in the same window of time. July 24th marks the day China begins a deliberate process of price discovery, stripping away layers of financial derivatives to find out what physical gold is actually worth when the metal has to move. This shift suggests that the price we see quoted on screens every day is a fabrication, disconnected from the physical metal it claims to represent. Today, when investors buy gold, they are purchasing a paper contract rather than a physical bar. The bank provides a promise to pay the going price later, while the actual metal supposedly sits in a vault. Because buyers rarely demand delivery, banks sell multiple claims on the same physical ounce. One gold bar is mathematically leveraged into 10 paper contracts. These contracts, not the metal, set the market price. The artificially high supply suppresses the physical metal's true value. This creates a market that cannot state with certainty how much of the underlying asset it actually holds. The official price exists on paper, while a different reality remains hidden in the vaults. In the decades following World War II, the global financial system relied on a single guarantee. The US dollar was the world's trade currency, and any government holding those dollars could exchange them for gold at a fixed price of $35 an ounce. By the 1960s, the United States was spending more on wars and social programs than it earned, printing more dollars to cover the gap. Foreign governments realized that with the dollar supply growing and the gold supply static, each dollar was backed by less and less metal. To protect the $35 peg, 8 central banks formed the London Gold Pool. Working out of the Bank of England, shown here in the 1960s, they sold their own national gold reserves into the market to suppress the price whenever it rose too high. The strategy failed when France and other nations began trading their dollars for physical metal instead. A run on gold began, escalating until the pool lost 1,000 tons of metal in a single week to defend a price the market no longer believed in. Inside the Bank of England, the physical infrastructure literally failed. Gold was being flown in from Fort Knox and stacked so quickly for weighing that the floor of the room physically gave way under the weight of the bars. On March 14, 1968, the market was forced to shut down. When it reopened, the illusion was over. The free market price of gold immediately jumped, leaving the official government price behind. Today, the global gold market is following the same sequence that led to the collapse in 1968. Central banks have begun offloading US Treasury bonds, the paper promises of the American government, at the fastest pace ever recorded. Simultaneously, these institutions are buying physical gold in record quantities. In 10 of the last 11 quarters, central banks have purchased over 200 tons of metal, with the World Gold Council estimating that much of this buying is never officially reported. The institutions that manage the paper market are quietly trading their own paper holdings for physical metal, betting that the quoted price is lower than the metal's true value. While the 1968 run on gold was a chaotic accident, China's current moves suggest a deliberate 3-part system designed to move the market away from paper claims. In Shanghai, the gold exchange now requires physical delivery. Every trade must result in metal moving from the seller's vault to the buyer's. To allow the rest of the world to participate, China is using Hong Kong as a gateway to bypass currency restrictions. In Hong Kong, the physical infrastructure is being built to match this ambition. Vault space is expanding from 200 tons to more than 2,000 tons. A market based on paper contracts requires no physical storage. You build room for 2,000 tons of gold only if you expect the real metal to arrive. Since 1976, the dollar price of everything has soared. A house that cost $44,000 then costs over $400,000 today. A new car went from $5,400 to $50,000. Weekly groceries for a family of 4 rose from $62 to $320. But when measured in gold, these costs actually dropped. In 1976, that house cost 335 ounces of gold. Today, it costs around 100. That car went from 43 ounces to 12. Even the grocery bill, which used to consume an ounce of gold every 2 weeks, is now covered for 13 weeks by that same ounce. Measured in gold, life has become less expensive over the last 50 years. The dollar lost its value, but gold did not. China's July deadline is the move that will finally force the global market to resolve the gap between those two realities.